It's 7:15 here on ABC Illawarra. So much talk about the banking sector, the need for reform. We're hearing this morning that the federal government plans to intervene basically in the lending market for small to medium business owners, a $2 billion fund to basically lend money, heighten competition with the four big banks, the federal government to use Commonwealth debt to inject more finance into the small business sector, lending money to companies that can sometimes struggle to secure loans. But post the Banking Royal Commission, what will things look like for us when we're trying to secure a home loan, for example? Now, someone who's been looking very, very closely at the Banking Royal Commission is local financial analyst based in Thirroul, Martin North, and he joins me now. Martin, good morning.
Hello.
So much happening really in the banking sector. It seems every day we're kind of confronted with a new world of how things will look post the Royal Commission, even though it's still ongoing. Why don't we talk about this story that was in the Sydney Morning Herald, first of all, about what ANZ will be doing in terms of tightening their lending criteria for home loan applicants. It looks like people will have to basically itemise every single bit of household expenditure for the past 6 months or so before they're even considered to be eligible for a loan. Is this the new world?
It is certainly becoming the new normal. ANZ isn't the only one. Pretty much all of the lenders now are being much more forensic in their analysis of expenditure. 18 months ago, if you had a pulse, you could get a mortgage, frankly.
Absolutely, yeah.
And in fact, even if you told them about your expenses, they would probably use a standard ratio called the Household Expenditure Measure, or HEM. So in other words, they didn't really care, because then, of course, the assumption was property prices would always rise, and therefore, even if you had difficulty, you could always escape, and the bank would escape, right? Now, of course, things have changed. Prices are sliding. The regulators have been providing a stronger set of guidance to the banks as to what to do. The banks are putting more of the acid back on borrowers, and so therefore now, if you want a loan, you will have to demonstrate a significant amount of more evidence in terms of the sort of patterns of expenditure, down to, have you got a pet? What are your holiday plans? And also, just at a point in time, you also got to produce now a bit of a history. So if you want to rock up at a bank and say, give me a mortgage, they'll say, show me the history for the last 6 months. So you have to sort of plan ahead and begin to work out in advance. And of course, the problem is, my surveys show that about half of households have no idea what they spend, because they don't really run a budget, and therefore for them it's going to be quite complicated and difficult. And those who are able to demonstrate that they can make those repayments under those new different schemes can get a loan. But what's interesting is that the total value that you can get compared with a year ago is down. So, your what I call the mortgage power, in other words, for a given set of income and expenditure, what you can get, down perhaps 25 to 30%.
Which was what was predicted back months ago now. So what I'm looking at a story from April this year about the prediction from UBS, the investment bank, that home buyers could see their capacity to borrow cut by up to 40%. So does that mean simply you would only be able to borrow 40% of what you have been able to borrow in recent years?
Yeah, that's right. So basically, you can now get a smaller amount based on the same parameters that you had 18 months or a year ago. And of course, that's one of the reasons why home prices are now sliding, because actually the strongest lever in terms of home price growth or not is availability of credit. So as credit availability gets tightened, essentially that drives home prices down. The other point, though, is that about 40% of applications that are now being put into the system are being rejected because of the fact that either income is too low or expenses now are too high. So the whole process of applying for a home loan has now got a whole bunch of additional hurdles. Many people are actually falling
short.
Unable. Yeah, and what it basically means is that the total volume of lending for home loans is going down. That's why we still think that home prices have more negative news ahead, I'm afraid.
Now, it looks like banks are already implementing these changes. We know that ANZ, you said that ANZ's not the only one, but that's the one that's been written about most recently, about what they are doing and what sort of advice or directive they've issued to their staff and their mortgage brokers. But we also know that just a few days ago, banks were arguing pretty firmly against Commissioner Kenneth Haynes' interim report saying that to do this, to tighten these lending standards, is going to raise costs. It's going to make things very difficult. It's going to make things slow and expensive. I mean, they're doing it anyway because they kind of have to. But is that right? Are we going to? Is the cost going to be passed on to us?
Well, there's no doubt that the extra time and effort involved is going to cost. Now, obviously, you can build systems to make some of this automated, but at the moment there's a lot more manual processing going on, so that is actually a higher cost. But you have to understand that the banks are trying to defend the status quo, right? Now, if you look at all the stakeholders, right, so the major banks have said, nothing to see here, a few minor bad apples, everything's fine, just leave us to get on with it, right? The smaller banks are saying the big banks have an unfair advantage. We need to actually have some help to actually create a more level playing field. The consumer advocates are saying, well, actually, the banking system doesn't work for customers and consumers, and it's needs to be significantly changed. And other advocates are saying, no, there needs to be a major restructuring in the banking system. So the Commission has got all of these bits of feedback. More than 300 submissions were released recently from his. This is a huge piece of work. Now he's going to try and navigate his way through this massive complexity. My own view is that his interim report highlighted that the fundamental thing that's changed in the banking system is that greed is now ruling the roost, and effectively it's about maximising profit of the banks, not maximising the outcome for consumers. And my own view is that we have to move to a banking system that has customers right back at the centre. Now, there will be some additional costs and structural changes probably flowing through that. We won't know until perhaps his next report coming out in February. But we could also now begin to see some of the architectural changes that we like to see. We'd like to see perhaps the banks sort of sliced and diced a little bit more, a stronger focus on consumers. But I don't think these changes to the lending landscape that we've talked about are going to be temporary. I think this is a permanent change. And the reason I say that is that the reason we've got our housing issues and our affordability issues and the massive debt burden that we've got is because we've had lending loose for a generation, right? And we need to get back to more standard approaches to lending. Now, to give you a little bit of a sense, the typical loan-to-income ratio in the UK is 4.5, right? So 4.5 times income to the value of the loan you can get. Here, it's still 7, 8, 9 times.
Which is just, is not sustainable. Eventually things, we'll have to leave it there, Martin. I'm sure we'll talk more. But in the meantime, if people want to refinance, get a loan, maybe even just get a foot into the housing market for the first time, things are going to be much more difficult for you. Martin North, thank you very much for your time this morning.
Good to talk to you.
That is Martin North, local financial analyst, talking about banks getting tougher on lending.